If we can trace the events of the last year to one pivotal moment, hark back to May 2013 when the Fed hinted that it would unwind the biggest stimulus package in world history. Though contingent on the US economy improving, investors focused on the end outcome. And a 4-month taper tantrum around the globe saw bond yields rise sharply and equity markets drop in what are normally uncorrelated asset classes. The ripple effect hit the still sensitive Eurozone hard, particularly in troubled nations Italy and Spain, which dropped 11.5% and 6.7% respectively. Concerns about the removal of liquidity from developed markets saw the rorts spread to emerging markets, putting downward pressure on both EM equities and currencies. This saw the Turkish lira plunge 22% and the South African rand tumble 20%. Adding to the May sell-off was a sharp spike in the Chinese interbank lending system rate, the SIBOR, which, although a deliberate government maneuver to control its shadow banking system, caused significant June falls in the Chinese and Hong Kong indices. Pleasingly, in December, when the Fed actually did start to pull back on their $85 billion per month bond purchasing program, the reaction was more positive, and this optimism has continued into 2014. The US has the ability to drive world growth if it can maintain current momentum, which is being led by a reinvigorated housing sector. However, with the S&P hitting new highs recently, heightened volatility in growth stocks and the recent falls in the Nasdaq suggests some investors are skittish on how much further the run can go. Although recovery in Europe remains fragile, with ongoing economic and political instability in peripheral countries, especially most recently in the Ukraine, the Eurozone has pulled itself away from the abyss. With the ECB committed to keeping interest rates low, we've seen a steady improvement in economic data, and the Spanish, German and French market indices have delivered strong returns. Japan has seesawed between the region's standout performer and its greatest threat, as the newly elected government instituted their own QE experiment in a last-ditch effort to revive the stalled Japanese economy, which has struggled with deflation for over a decade. This saw the Nikkei pull off outstanding gains in the last 2 quarters of 2013. But weaker results recently have commentators wondering what the BOJ's next move will be. How China manages the transition to a market-led economy and the implementation of market reforms will play a crucial role in global market sentiment. Against the backdrop of a slowing Chinese economy, the end of the mining boom, weak domestic consumer sentiment, and a domestic election that failed to deliver the renewed stability and focus many were hoping for, Australia has proved surprisingly resilient, with only one negative quarter in almost 2 years. A general recalibration of growth expectations downwards has seen Australian companies replace aggressive leverage and expansions with cost-cutting, fiscal discipline, and return of capital to shareholders. This, combined with the flow-on effects of historically low interest rates, has seen investor optimism return, with housing, consumer sentiment and employment measures showing considerable upticks. So where to from here? At current levels, valuations are being questioned, especially in financials, and the high level of the Australian dollar may present headwinds for domestic cyclicals. Resource names have remained remarkably resilient, but with demand waning and concerns about supply, further upside in prices could be limited. Additionally, will the latest initiatives out of the federal budget place downward pressure on already subdued demand? The key drivers for the market in 2014 are whether companies can deliver on earnings growth commitments and how successfully the economy is weaned off the mining boom. Positive outcomes here will foster a third successful year for Australian investors.